What if I told you the next stock market crash won't start on the Wall Street? It won't start because of bad earnings anymore. No, it won't start because investors suddenly panic. It will not start because of that. It could start thousands of miles away in the Middle East. And according to a shocking new report, one decision involving Iran, oil prices, inflation, and Federal Reserve may just put the entire stock market in the position it hasn't been for years. But here's the crazy part. Most investors are looking at stock prices, but that's wrong. While the real danger is building underneath them. Now, what just happened in the stock market? Let me start with the bigger picture here. Recently, tensions involving in Iran escalated dramatically, as everyone knows that. Markets immediately focused just on one thing. What? It was oil. Because whenever geopolitical conflicts threaten energy supplies, oil prices can move very quickly on a very positive side, means go higher and higher. And when oil rises, everything becomes more expensive. Transportation, manufacturing, shipping, and food, the food what you're buying every single day, and consumer goods. Literally, I'm talking about every single thing in life will become expensive. That's because oil is embedded in almost every part of the global economy. Now, here's where the things can become more dangerous. The United States has spent years and years fighting inflation to keep lowest as possible, and Federal Reserve aggressively raised interest rates to cool down the economy and bring inflation back down to 2% target. But for a while, it seems like a strategy was honestly working. Inflation was slowing down, rate cuts were being discussed. Investors were celebrating every year and year, but then this new risk appeared. If oil prices continues climbing, inflation could rise super fast. But wait, what happens if inflation suddenly start rising again? This is where things can get very nasty, uncomfortable for the investors. Now, there is a big problem here. Federal Reserve has one primary mission: to maintain stable prices and support employment. If inflation starts accelerating because of higher energy costs, the Fed may have no choice but to keep interest rate higher for a longer period of time. In a worst case scenario, raise them again. Historically, higher rates are rarely good news for the stock market. But why is this? Because money becomes more expensive, and businesses, they borrow less. Consumers, they spend less. Corporate profit, they just go down. Shrink. And economies, they shrink. When the growth slows, the stock valuation often what happens? It goes down. Many investors have been betting on rate cuts. Markets have been pricing in a friendlier Federal Reserve. But if inflation return backs of oil shocks, those expectations could be shattered overnight, and Wall Street hates surprises. So why the market is so vulnerable right now, even after the good earnings? Let me explain it step by step. Something many people aren't paying attention to. So the stock market today is extremely concentrated. A small group of giant technology companies has been responsible for this, for so much of market's gain. Like companies benefiting from AI, cloud computing, and semiconductors. These are one of the biggest reasons, and also the digital infrastructure. But here is the biggest issue. These companies trade at premium valuation, and premium valuation requires confidence. Confidence in growth, confidence in earnings, and confidence in that interest rates will eventually fall. If interest rates remains elevated or move even higher, those valuations suddenly become much harder to justify. That's when investors begin reassessing risk. And when large institutions start reducing exposure, selling can accelerate very quickly. Not because companies are bad or they're just falling down, but because the environment has changed. That will become one of the biggest reasons. Now, here's the part almost nobody's talking about. I know this because it's just crazy about stocks. The next move from Federal Reserve might not be the biggest story. No, who is running the Federal Reserve could be the biggest story. So according to the discussion highlighted in the reports, attention is turning towards Kevin Warsh. If leadership changes occurs at the Federal Reserve, market will closely examine every statement, every policy, every signal, and every decision. But why? Because credibility is every single thing right here. Investors need confidence that the central banks remain independent totally. They need confidence that inflation will be controlled. They need confidence that economic policy isn't being driven by the political pressure. If markets being questioning that independence, volatility could increase significantly. Financial markets don't react to the policies. They react to trust. And once trust starts breaking down, uncertainty grows super fast. I mean, rapidly. Now, what smart investors are really watching on the Wall Street? They're not watching for sure headlines. They're not watching social media panic. They're not watching emotion predictions, but they're watching these 4 indicators. Number 1 is oil price. If oil continues rising aggressively, inflation risk increases. And number 2 they're watching is inflation reports. These tell us whether prices pressure are returning or not. And number 3 is Federal Reserve statement. Every word matters right now, every single word. Number 4, corporate earnings. Strong earnings can help support market even during difficult environment. As for now, the smartest investors aren't predicting a disaster, they are preparing for multiple outcomes. Now, here is the biggest reality. The market isn't crashing today, right now, no. Nobody knows exactly what happens next. But we are entering a period where oil, inflation, geopolitics, Federal Reserve policy are colliding at the same time. That's a strong combination investors cannot afford to ignore anymore. The biggest money in the world isn't asking, will the market go up tomorrow or not? They're asking something else. What risks are building beneath the surface? Because fortunes are rarely made by reacting after the crisis begins. They're made by seeing the warning signs before everyone else. So the question is, are these warning signs the start of something much bigger or not? Or probably just another temporary scare. So tell me, what do you think exactly in the comments? What will happen to the stock market? And if you enjoyed this analysis, hit the like and subscribe to the channel and turn on your notifications, because the next few months could be some of the most important months for the investors in years. Thank you. See you in the next video.